Hey, I'm Ryan O'Connell, and in this video, we're going to be diving into electronic traders and trading systems, and more specifically, we're going to be looking at these learning outcome statements, which say that we need to identify and contrast the types of electronic traders. So we'll go one by one and talk about who they are and what they do. Describe characteristics and uses of electronic trading systems, and describe comparative advantages of low latency traders, and we'll get into what it means to be a low latency trader. So let's dive in. Now let's go over the types of electronic traders. The first one being news traders. Now news traders react quickly to news releases and profit from stale orders. For example, let's say a news article just came out that said NVIDIA's earnings this quarter are going to be much higher than previously expected. Well, a news trader will try to quickly profit off of some stale order that's still in the order book that was going to, say, sell the stock for a lower price than it really should be based on that new information after this news release. So it's sort of picking off the slow people. Dealers, they make markets and profit from bid-ask spreads. So really they're holding the inventory of these instruments or securities, and they're not looking to take risk. They're just looking to connect buyers with sellers and profit off the spread in between. Another type of electronic trader is arbitrageurs, who exploit price differences across markets, and they try to create arbitrage portfolios, which are riskless profits by taking advantage of discrepancies that really shouldn't exist. Another type of trader are front runners, who use AI to anticipate orders by recognizing patterns and front run trades. So let's say there's some big company that is offloading some large position or some large holding, and they're selling in every 10 minutes, they're selling X number of shares as they try to offload this whole position. Well, this would use AI to try to recognize that pattern and say, hey, if they're selling a large chunk every 10 minutes, well, maybe we can predict the next couple sales and try to front run those trades. The last type of electronic traders that's discussed are quote matchers. These traders exploit standing orders to limit losses. I'll give you an example. Let's say there's a slow trader that has put in a standing order at $20 for some stock. Well, a quote matcher could buy this share at $20 from someone else, and then if the price goes up, then they benefit from the price rising.